What's up everyone, my name is Joris, welcome back. In a previous video we talked about assets and liabilities and how the rich invest in assets and how you should do. You should ignore liabilities and focus on assets as much as you can. But what if you can take a liability and you can turn it into an asset? That would be great, right? Well, in this video we will do just that. I will explain how I managed to turn some of my liabilities into assets, and items that previously cost me money are now making me money. Let's quickly revise the differences between assets and liabilities. But first things first, click the like button on this video and subscribe if you have not done that already to be notified when a new video comes out. Assets are possessions. They can be tangible or intangible. An example of a tangible asset are rental properties. Intangible assets are investments in the stock market, the bond market, the government bonds, and so on. Assets will either make you money or save you money. A rental property will generate an extra income every month, while a bike will save you money on gas and transportation fees. Liabilities, on the other hand, cost you money or limit your potential. A brand new car loses 15% of its value the moment you drive it off of the lot. It is often more interesting to buy the same brand of car that is a few years old. The pricing will be way more interesting and you might sell it at the same price or at a little lower price after a few years. So you're limiting your expenses on the car. An expensive watch or phone, although they look cool, are liabilities. You're spending money on an item that will not help you. The high price will even limit your possibilities of investing and thus setting you back on your financial journey. But some liabilities can become assets if they are used correctly. I'll give you some examples of what I have done. Some experts say that your own house is a liability. I personally think it's not. Because interest rates are so low, you're paying less in interest than inflation is going up. Thus, your mortgage payments are effectively a sort of saving account with a better return than your normal savings account in the bank. They say your house will be a liability if you have to sell your house during a recession because you won't be able to pay off your mortgage. You'll have to sell your home under value, and as a result you have a risk of losing the roof over your head. It is true that your house can be a liability if you buy a house that you cannot afford. But if you buy a house within your limits, in mortgage payments you'll be paying off around the same you would be in rent. In that case, you're actually saving part of the money you're paying off every month in equity. You need a roof over your head anyway, so you might as well just pay off a mortgage instead of paying off rent. The key takeaway here is to not live beyond your means. Invest a reasonable part of your income on housing. That means to downscale if needed. A golden rule here is to invest a maximum of 33% of your income on housing and housing related costs like upkeep and utilities every month. I believe your house is an asset, but only if you do not have to worry about your monthly mortgage payments or if you have completely paid it off already. It's a great way to save for the future. The prices of housing will generally go up in the future. But if you're struggling to pay off your monthly mortgage, it is a liability and you should probably downscale. Sell your house, buy a cheaper one. Your house is an asset. Your own roof over your head makes sure that you do not have to spend money on rent. And the major part of your monthly mortgage stays in your own pocket, the equity of your house. If you pay a monthly mortgage of 850 euros in housing, with interest costs of 200 euros, your actual cost of living is 200 euros, since the 600 euros in equity paid off will remain in the value of your house. Of course, we can argue the housing prices might drop and the 600 euros in equity will be worth less in the future. But the opposite is true as well. If housing prices go up, your 600 euros paid off equity will be worth more in the future. Now, how to use your house as a money generating asset. The easiest way to make your house generate money is to rent it out. For example, you go on a holiday in August and you rent out your house. I personally host on Airbnb, so I rent out my own apartment to tourists in Antwerp, thus generating me an extra source of income. On the one hand, I am paying off my mortgage every month, And on the other hand, house prices generally will go up in the future. And on top of that, I'm getting income from the Airbnb hosting I am doing here. Now, let's look at the numbers. The mortgage on my own apartment is around 500 euros every month. I pay down 350 euros in equity, 150 euros in interest. On top of that, I receive around 1000 euros net per month in Airbnb revenue. Of course, there are costs of renting it out, but basically it lets me live for free in my own apartment. Monthly payments of 500 euros plus my monthly utilities of 150 euros, 650 euros cost of living in this apartment. By earning 1000 euros every month net via Airbnb, I get paid 350 euros just to live here in Antwerp. In essence, I have converted my own home, debatable if it's an asset or a liability, into a part-time rental property. So it is an asset, it's generating me extra income every month. Of course, income via Airbnb or other short-term rentals are variable during the months in the year. In the last 4 months, I have had just one single visitor in my apartment. But last year, an average of 1000 euros was possible over the whole year. I hope things will revert back to normal soon. Here is another example. I used to play the saxophone, but nowadays I'm too busy to keep playing. And thus, the instrument was sitting in a corner in my apartment gathering dust. It costed me money for the upkeep, to keep it cleaned and working. A few years ago, a friend of mine wanted to pick up playing the saxophone, and he asked if he could rent mine. So now he does rent my saxophone. It's great for the instrument, it gets played, and it's also well maintained now. And it's also great for my pocket. This former liability gathering dust in the corner of my apartment is now making me a few euros every month. Whether an item is a liability or an asset, it really depends on how you think about it and how you're using it. A rental property that is rented out is obviously an asset, but if it's vacant for a very long time, it might become a liability. If you have a bike standing in the garage, never being used, it's a liability. But if you use it to go to work instead of going by car, it can be an asset. You're saving money on gas. If you have an expensive car, it is a liability. But if you find a way to rent it out or make money with it, it can be an asset, for example with Uber. You have to be creative and find new ways to create your own sources of income. It is equally fun and rewarding. Take the time to assess your liabilities and try to change them into assets, generating you more cash. Let me know what you think. I'm very interested in all your creative minds. And don't forget to smash the like button for the YouTube algorithm and to subscribe to the channel if you've not done that already. In this coming week, think about all your possessions. Which ones are liabilities? Which ones are assets? Do you really need all those liabilities? And if not, just get rid of them. Or better yet, try to take those liabilities and turn them into assets, generating you money over time. I thank you for watching, and I'll see you next time.